All right, guys, welcome to Financial Literacy 101. This class is, this Zoom meeting is for teenagers and adults that need a little bit more information on financial literacy. So I'm going to give you a background about myself, and then Dr. Ilyayev will give a background about himself. So I'm police officer currently. I've been in financial industry for about 17 years before becoming a police officer. And now I'm actually a part-time registered representative. I'm fully licensed with the state, and this is not a sales seminar, okay? This is educational seminar. So that's my background. Just a little bit of more information about myself. I came to the country when I was 16 years of age, and I wish that I knew this back then, but I got into investing when I was about 19 and never looked back. Okay, just hopefully, again, you will learn so much from this that you will be able to make a difference for yourself and even start earlier if you're in your early teens. And Dr. Ilyayev, if you don't mind, introduce yourself.
My name is Dr. Emmanuil Ilyayev. I'm a dentist, but I also have a passion for the stock market. Dentistry is also kind of a hobby of mine where I like to help people look better. And I like the gratification after a patient comes to me with pain, and then I help them get out of toothaches. And the second hobby I have is the financial markets. I love the possibilities of it. I like the potential of having your money make you more money. Now, Peter and I were both licensed reps for Primerica, and we help people with life insurances, IRAs for retirement, investments such as mutual funds. And today we want to share the knowledge of the markets that we learn with you in hopes that you will learn how to turn your money into employees of yours to make you more money.
And first, we have to start with disclaimer because this is a very highly regulated industry. All right, so what we are talking about today is not a financial advice, okay? Everyone is different, and when we do financial advice, we have to speak to a person one-on-one. There is no such thing as one shoe fits all, okay? So as long as you understand whatever we're discussing today, it's not a financial advice for you, but a general education. This is our disclaimer for today. Now, the other thing you need to know, there is nothing in life that is guaranteed unless it's death and taxes. Okay, but there are a few tools that are also guaranteed, and we will mention as we go along. We also will provide our phone numbers at the end of the seminar, and if you guys have any questions, we will be gladly to help you. If you have any questions in the meantime, you can post them in a chat. Please do not unmute yourself because that's not going to help us out. Post questions in the chat. If we feel that this is something that we should address, we will address at the end. If we feel that this is a personal question, then if you want to stay back afterwards, after everyone is gone, we can speak about it, or better yet, just text us or call us after, and we'll be able to do one-on-one. Okay, let's go to the next slide. This is a great quote. If you give a man a fish, you will feed him for a day, but if you teach a man to fish, you will feed him for a lifetime. This is, if you think about this, right, this is what we're trying to do today for you guys. Again, like I said, we're not trying to sell you anything. This is pure education. And we're hoping that by learning today, you will be able to understand what investment world is all about, and you will be able to make yourself better. Now, I understand also that some maybe teenagers here have parents that are well off, and maybe becoming a millionaire is not something you're looking for because your parents may be already there. But the thing is, if they leave you $1 million or even more, and if you have no idea how to handle your money, that money is going to be gone very fast. Okay, as a matter of fact, if you Google a history of lotto winners, you will see that many of them became broke just a few years shortly after. Okay, because it's one thing to have money, the other thing is to manage money. Okay, and know what to do. And remember this, it's not how much you have, it's what you do with what you have. Okay, without further delay, Dr. Ilyayev, you want to continue?
Sure. There are 4 ways to earn income. There's the employee, there's the self-employed, there's the business person, and then there's the investor. Now, the employee has a job, but the negative is that the income is based on the position not the person. For example, let's say you're a teacher and you've been a teacher for 2 years and you're the best teacher in the entire school. Then there's another teacher in the same school who's been there for 10 years, but they're not as good as you are. Who do you think is going to earn more income? You or them? They are, because they've been there for 10 years. So the income is based on the position, not the person. Next, there's the self-employed. He owns a job, is a dentist, a medical doctor, a lawyer, hairstylist, real estate agent, salesperson. The better you are at your craft, the more money you will earn. But the drawback is you'll either max out or burn out. There's only a certain amount of patients or clients you can take upon yourself in a day, right? So your income potential is limited. After self-employed is the business person. The business person, they own a system. They have others working for them, right? A business person has unlimited income potential. A business person would be, let's say, a person who runs one or many dental offices. They have dentists working for them. So let's say if the business person goes on vacation and he's not in the business is still producing money, right? The business person has more flexibility. After the business person, the next level, a higher level, is the investor. The investor has money working for them. They enjoy complete freedom and they live the dream. That's the level that we all want to be at, right? The investor is where we want to be. The investor has their money making them more money.
And I just want to add something. So during COVID, we've seen a lot of places go out of business, okay? Because, for example, when you're self-employed, the government said you have to close your offices. If you have no other stream of income, then how do you make money? So a lot of self-employed people really suffered during COVID, where the market was open, okay? Just something to consider. Now, this is a sad statistic, and you can actually Google, but this is coming from CNN Money, okay? 78% of full-time workers live paycheck to paycheck. This is sad reality, okay? And unfortunately, another statistic shows, and I didn't put it here, but you can Google it too, about 70% of Americans don't even have $1,000 saved. That's insane, okay? So what's the problem? Most people don't get financial education. I wish that in school, in college, they would cover that. But what happens in school? You don't get that. What happens in college? Not only you don't get that, but you graduate college with thousands of dollars in loans, okay, without knowing how to manage those loans. And a lot of people are struggling later on in their life, trying to manage their rent, they're paying off loans, and so on. People don't have a financial game plan. That's another big problem. A lot of people get paycheck, it goes into bank account, they spend that money, but what have you done to manage that money? What have you done to make that money grow? And a lot of people don't have a financial coach to be able to guide them. And that's what we're going to offer you guys. We're going to offer you a mentorship. Again, there's absolutely no charge. This is something that we're doing for community, for others, because years ago, someone helped us. And this is just our way of giving back. All right. So if you guys need anything, anyone wants a financial coach or mentor, please reach out and we will be there for you. Okay. Now, and like I said, the results and serious challenges for families. You want to take from here? Okay, I'll actually do it. So guys, get familiar with the rule of 72. So rule of 72 basically states that if you take 72 and you divide it by the interest that you're getting, it will tell you how many years it takes to double your money. For example, if you hold your money in a savings account, and you can do a research, just call your bank and see how much well, look at your statement. You will see that you're not making anything at all if your money is in checking or savings account. Most of the savings bank don't even give you 1% back. So rule 72 says if you divide that by interest rate, and let's take 1%, but like I said, most of the banks don't even give you 1% back. That means you're going to double your money. Let's say you put $10,000, your 10,000 will become 20,000 in 72 years. If you put it at 3%, it's going to double on a 24-year. If you put it at 6 at 12-year, and look at this, if you put it at 12%, you can double your money within 6 years. But again, where do you get that 12%? And that's something that, remember, nothing in life in guarantee, I told you, right? But we will go over a history of investment, and we will show you that there is a possibility, and not only to get 12%, but you can also get even more. But again, we try to leave it to 12%. We don't want to go over the board with that. Okay. Let's see. And again, this is something that you should have learned in school, but it's never too late. So you're learning this today. All right. Now, here's a good question for you guys. And before I move to the next slide, try to come up with an answer before you see the final number. What if, ask yourself a question, can I save $16 a day? $16, for some, it may seem a lot. For some, it may seem like, that's just $16. Of course I can save. So here's the thing. If you cannot save $16, maybe because your income does not allow, maybe you're still in your early teens and you don't make that money. Hopefully this will be a reminder when you start making money. And if you're already working and you cannot save $16, then what I recommend is take a look at where your money is going. And by that, I mean, try to keep a track of everyday spending for about a week or two. And keep a like a maybe notebook where you record at the end of the day, how did you spend that money for today? And then at the end of the week, do a summary. And you will see that a lot of times our money is going to the things that we don't need, because there is a huge difference between I want and I need. And when you can determine the difference between that, you will be very successful. I'll give you a quick example. Very often I'm walking on the street and I see people carrying fancy water bottles. Okay, you did not pay $1 for that. All those fancy water bottles, they probably $1.50, $2. I see people with Starbucks cups. That's easily $5, $6 right there. There is nothing wrong with grabbing a water bottle that you can refill at home, or instead of getting a Starbucks coffee, learn how to make a fancy coffee at home, right? Now, just think about it. Starbucks coffee alone, that's about $5 to $7. I don't drink coffee, so I know the range is about $5 to $7. But here's a partial amount of that $16 a day that you can save. So $16 and change, that comes up to about $500 a month. That's about at 30 days a month, right? So that's about $500. So if we invest every month $16 a day or $500 a month for 30 years, and for those of you that are teens right now, let's say you are 16 years of age, next 30 years, before you become 40, okay, let's see how this amount can be, just $16 a day. So at 10% rate, we're gonna do 10%. When Dr. Ilyayev covers the market, you will understand why I'm using 10%. So I'm gonna show you the number right now. But before I do, just try to guess for yourself. Don't go live because we don't want you to be unmuted, but just to guess for yourself how much it will be, okay? And usually when people guess, they say 150,000, 600,000. Well, here's the number, 1,140,000. So everyone who is sitting in this chat, in this Zoom right now, if you guys learn what it is by compound interest, and Albert Einstein said compound interest is the ninth wonder of the world. And basically what compound interest is, I'll give you a quick example. Let's say you put $100 into a bank. And let's say with the interest, bank gives you $1 next month. So now you have $101. So, but the month after, the interest will be not on $100, but on 101, which means the money that the bank is going to give you next time, it's not going to be $1, but maybe $1.02. So the month after, the interest will be added not on 200,002 cents, but 200,000, like 202,000, maybe 20 cents. So every month, your interest will be added on top of the interest that was given to you for the prior month, and that's what's called compound interest. So in 30 years, your $16 a day can be $1,140,000, and that's just at 10%. Again, we will show you where you can make more, and even if you make less, I would think that if you're not even 40 years of age and you have over $500,000, that's a good amount to start with, right? I'm sure most of you will agree. And like I said, some of you may have parents that will pass that inheritance to you, but will you know how to manage the money? That's where the problem lies. Okay.
A question we often get asked is, how do I become a millionaire? As Peter just demonstrated for you, invest $500 per month for 30 years. Oftentimes people tell us 30 years is too long. So we tell them invest $2,700 per month for 15 years. That's too much money per month. There's no shortcuts to investing. This is not a get rich overnight. This is about being in the market for a long period of time. The longer you're in the market, the more money you will get at the end. Now, since 1926, the average bull market length is around 6.6 years. The average bear market length is around 1.3 years. Now, when we have a bull market is when the market is going up, by the way. The average bull market gain is around 339% in the good years. The average bear market loss is around 38%. So the lesson is it pays to play the long game.
And by the way, guys, we're right now in a bear market. As the market right now is not doing well. We're in a bad economy currently. So we're right now experiencing a bear market. Okay. But again, this is a history that you can actually Google and to see what the history is. But we already have the numbers for you.
Now, the average market return is 10%. There is a difference between investing and gambling, right? A lot of people day trade. We consider that gambling. Holding solid stocks or mutual funds for long term, that's real investing. No one out there, no hedge fund manager, no one out there knows if a stock's gonna go up or a stock will go down in the short term. That's impossible to know. No one knows when the next market crash will be. All we know is that historically, the average stock market return on the S&P 500, which is the Fortune 500 companies, the top 500 companies in America, the average return has been 10% per year.
Now, guys, just want to mention something. A lot of people, you probably heard day traders, and so on. Well, first of all, I want you to watch the movie. It's called Wolf of Wall Street. Okay, because unfortunately, what I have seen, and just to share a little bit with you, I don't consider myself a day trader. I'm a swing trader, which means that I buy something today with the plans that I'm going to sell something in a week or so. But I also have a long-term portfolio. And I recently became a swing trader. I always was a long-term trader. But if you decide to go into day trading, first you need to learn fundamentals. Okay, we're going to go over that. What's the easy way to start and so on. But for anyone who is doing day trading, please, 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 I beg you, don't go by what a friend of a friend told you that's going to make you a millionaire. Especially someone probably, if you guys heard about cryptocurrency, maybe you heard the word Doge. A lot of people were investing into that because they thought they're going to be millionaires overnight. And some people did well. But unfortunately, a lot of the stocks with unknown names get pumped and they get dumped right away. So you as investor will have no idea when you need to get out, where professionals, they do it day in and day out. They will get out and then you're going to be left with a stock that's worthless. All right. So be very careful.
Now, we're going to go over some stock market crashes, right? Because that's what everybody's worried. People are worried that if you put in money into the market, that you're going to lose all the money you put in. So historically, 1973, the stock market crashed 48%. 1987, 29%. In 2000, the dot-com bubble crash was 49%. In 2008, the Great Recession was 57%. In 2020, the recent COVID crash, that was 34%. And now we're also kind of in a bear market where the market has gone down 20%. But knowing all this, since 1926, even with all these crashes, the stock market has still increased 10% on average. Okay.
And guys, I just want to explain to you how the market works and how you can be successful in the market without risking a lot. Well, first of all, let's talk about what is a stock and what is an alternative to a stock, which is mutual funds, exchange traded funds, and so on. So the stock is, let's say, and we're going to have a few slides on actual companies, but when you're buying a stock, you're buying individual company. So for example, if Apple needs to raise money, they will sell you a stock of Apple and you will buy a stock of Apple and you will become a partial owner of Apple company, a very small owner of the company. If something happens to Apple, and if you don't think that anything can happen to Apple, I'm going to use Sears. And for some of you, you may not even know that name, but Sears for older guys or girls was a pretty much a well-known name because Sears at one point was one of the largest companies in the United States. Now Sears is nowhere to be found. So if you think Apple will not go out of business, we don't know that. 10 years from now, they could become another company that will be much greater than Apple, and Apple will lose all the clientele. So when you're investing into a stock, there is a huge possibility of you losing money, especially if you're investing into a company that is not well known. Now, for someone who is new and who wants to start trading stocks, I always recommend don't buy a stock that you never heard before. Buy a name that is well recognized. And I'll give you again, everyone knows McDonald's, everyone knows Apple, everyone knows Amazon. Those are the names that are recognized. Now, I'm not saying you should go in and buy those stocks because, again, every individual is different and what works for one may not work for another. But if you don't know the name of the company, if you never heard, why would you invest into a company without knowing what's behind that company? Okay,
Right.
so is there a safer way to invest? Yes. The safer way to invest for beginner would be a mutual funds or exchange traded funds. I'll explain with mutual funds because exchange traded funds, it becomes a little bit more confusing. It's for a little bit more advanced, but if you guys have any questions, we can always chat after. So mutual funds are a combination of many different companies taken together. And when you buy a share of with that one mutual fund, you're buying all of the companies, very small shares of all of the companies together. For example, you can buy Apple right now. I believe right now Apple is about $153 a share. Or you can buy a mutual fund. And again, there are many different companies, many funds out there. Which one to buy, which one not to buy. This is when you sit down with professional and discuss your situation, in particular. So you can buy a stock of a mutual fund company, let's say for $50, and within that $50, you will have Apple, Amazon, Facebook, Google. You can have S&P 500, all large 500 companies together. But what I'm trying to get to it, for a beginner, if you don't want to risk investing into mutual funds, could be a better idea because you're diversifying, and that means that you're investing into many different companies at once. And even if, let's say, Apple goes out of business, even if Facebook goes out of business, if you invested in another 400 or 500 companies at the same time, the chances are pretty slim that all of those companies will go out of business at once. Okay. Now, how do you make money where if the market crashes, you don't lose? So it's called dollar cost average. The best way to invest into a market is when you invest monthly basis. So for example, let's say you had $1,000 to invest. You can put 500 down, and then you can put 50, 100, $25 every month to invest into the market. And I'll give you easy example. Let's say you're buying today one share at $100, and that $100 bought you one share. Tomorrow something major happened and the market crashed. It went to $1 of the same fund. Now the same $100, if you're investing monthly, will get you 100 shares at $1. And what will happen is when the market recovers, and it will, because history shows that, and we had even worse years than what we have right now, then let's say it goes to $50. So yes, you're still losing on that one purchase that you made at 100, but you just made a $49 profit on 100 shares that you purchased at $1. So you see, but for people that invested all at once, they're going to have to wait a couple of years before they actually go back to 100 and plus recover more. Okay, so investing monthly, sometimes you can even do bi-weekly, weekly, it's really up to you. But investing at least monthly is the best way to survive in the market, even when it's down.
Somebody
Now,
posted something about market manipulation. We don't care about that because we're in it for the long run. Like Peter said, we're daily cost averaging in, where we're putting in money on a monthly basis. When the market comes down, we're buying shares, we're buying mutual funds for a cheaper rate. When the market recovers, now we made some money.
Now, I want to point out 2008. It's listed here that stock market crashed 57%. The next slide that we have is actually from one of the mutual funds that I personally have. And take a look, when the market lost 50 plus, this mutual fund in particular lost 30%. Okay, that's a lot. If you're investing, let's say $1,000, losing 30%, that's a lot. But look what happened next year. Next year, the market on this fund particular returned 34% and change. Take a look what happened years after. We only seeing negative in 2015 again for this fund. All right. So remember how I said 12% is, I don't want to go more than 12%, more than 10%. You got funds that making way more than that. But again, we don't want to disclose that because in life, like I said, there's not, you can't guarantee death and taxes only. But if you look at the history, and this fund been for ages here, you see it goes back to 1950s. So the history, by looking at it, you can for yourself try to figure out if this is something that you want to get in or not. And even in the bad years, if you lost 4% here in 1973, 12% here, look, next year in 1975, not only you recover that loss, but you actually made some money. And look, year after, 22, 8, 28%. That's insane. That's a very great numbers to have. You will never have that money if you keep your money in a bank. And that's why I always said, it's not how much you have, it's where you put that money in. Okay, your money can be sitting in a bank account making 1% because you're afraid of the market. Yeah, people lost 30% and you're happy because you saved your money. But look what happened next year. Everyone who lost 30%, they recovered. Look what happens after that. And you're still sitting in your bank making 1%. Now, some people can say, what I'm going to do is, when the market is going down, I'm going to take my money, put it in a safety zone. And when the market comes back, I'm going to go back into the market. What you're going to try to do is you're going to try to time the market. Timing the market never works. And here's why. Well, if you're selling your portfolio when you see that the market is going down at 30%, you automatically lost. Because remember, this is not a loss if it's on a paper. It's only a loss if you actually sell. But when you buy, how do you know when to go back into the market? Oh, because it returned 34%, now I'm going to go back? Well, guess what? Over here you lost, and over here you're going to lose again because now you're going to buy everything at a high price. But if you let it ride, and instead of taking the money out, add more money in, can you imagine what this will be if you bought at 30% discount, everything that wasn't here down 30%? Just think about that, okay? Now, Manny, you want to go over this?
Sure. This is the S&P 500, the Fortune 500 companies in America, right? This screenshot is taken from August of this year, and it's showing that the S&P 500 is 4,140 points. If you look below it, it says, what's the year on it, Peter? I can't see.
August 13, 1982, $103.85.
Yeah, in 1982, it was 103, right? Look at the increase from 1982 till now. Imagine
this is August 8th slide, just so you guys know, we created this on August 8th, so it's a little bit dated, but
a $10,000 investment in the S&P 500 index fund in 1982 would be worth almost 400,000 today. Imagine people that put in money in 1982, how much money they have today from that, right?
And here's the stock that everyone familiar with, Amazon. Again, this was taken on August 26th. So Amazon right now, it's actually down. It's about $94 right now. But look where it was on March 20th, 2008. It was at $3.66. Okay. But again, did we know back then that the Amazon is going to become a monster? No, but people that expected that this could be something big, they invested. And right now they don't have millions, they have billions. If they bought Amazon a bunch of shares at 366, okay? But Amazon is such a huge company. And again, I don't want to go over individual stocks, but if you look at it, this was in August, Amazon was 130. Now Amazon is down to $94 approximately, right? Will Amazon go back to 130? In my opinion, absolutely. Why? Because Amazon is a solid name. But if you're buying into something small company you never heard before, you may be out of the money. And what if company declares bankruptcy? That money is gone. That's why we strongly recommend for beginners to start with the mutual funds. Here's another good one, Apple. $3.16 on January 23rd, 2009, August 26, 163. Apple right now, it's actually in the 150 range, 140 range. It goes back and forth. Again, solid companies, solid results. But what if Apple goes out of business? You're losing money if you're investing in one company alone. With mutual funds, you can have all of that together. Now, the next topic is actually pretty big, and I know we have a lot of teens on this, right? But I'm gonna cover this because you need to know this, because unfortunately, so many times I'm on the Facebook and I see everyone, whoever has a GoFund, they're asking for money, and you may have seen, or maybe you know someone who lost a parent or a sibling, and the family having a hard time to afford life insurance. I'm sorry, to afford funeral expenses. So keep in mind, life insurance is a topic that's very rarely discussed because people are afraid, oh, if I'm going to open a life insurance, something is going to happen to me right away. But this is not something that people think about it a lot of times. But unfortunately, it's a topic that unfortunately we need to address because this is very important, and this can make a huge difference between your family or you needing to open up a GoFund or being able to support themselves. So there are fees that are associated with that. To cover everything in details, it's way above this presentation. But you have funeral costs. You have if you get married, think about this. Let's say you get married, you have a baby, and spouse passes away. Are you going to be able to afford to handle the baby on your own? The daycares cost a lot of money. Will you be able to pay for that and have a job? So life insurance helps with all that. However, there are different types of life insurances. Okay, and here's a small slide. A lot of times, and if you have your parents next to you, I strongly recommend they take a look at this, because a lot of parents have houses, have cars, but something as simple as life insurance, a lot of the parents never thought about it, or maybe thought about it and postponed it for another day. But it's so important because this can be a huge difference between I need help from community, I need help from friends, versus I'm struggling because I lost a loved one, but I'm good. And I want to show you a quick example of what I consider a right life insurance and not so right life insurance. So we have there are different ways of whole life insurance. Basically what it means is, again, I'm not going to go too deep into details, but basically there are two major life insurances. There's a whole life, and basically you pay until you die, and then your beneficiary gets the amount. And in this example, this is for $500,000 for a person age 40. Okay, as you can see, $3,000, it may be a lot of money. Now, on the right side, there is a term insurance, which is $594 for the whole year. Now, $594 for the year, that's just a couple dollars a day. I'm sorry, not even a couple dollars. It's less than probably $1 a day. Okay, so why would someone buy a whole life versus why would someone not buy a whole life and buy term instead? So when whole life sold, unfortunately, a lot of agents sell whole life the wrong way. And whole life is sold, basically, this is what I heard from other brokers, insurance brokers selling it out. Oh, you're going to have a cash value in there, which means if 10 years down the road you need money, you can borrow from your policy. However, they forget to tell you that there is an interest rate attached to that loan. You may be paying anywhere from 6 to 12% of interest rate that is in a very small letters in the policy that a lot of people ignore to read. So you're basically borrowing your own money and you're paying interest for your own money. Then they can say, oh, a few years down the road, 20 years down the road, you can stop paying for your policy. Well, that money is coming from your cash value. And the problem is, again, when you pass, the family does not get $500,000. They get $500,000 minus what you borrow, minus the interest rate. So I personally never sold whole life and never will, because in my opinion, everyone can benefit from a term policy. And this is how. I propose buy term, invest the difference. And by that, I mean, if you were able to afford $3,000 and instead for the same thing, for the same $500,000, you're going to be paying $594.99 a year versus $3,000, that's a savings of $2,455 every year. If you divide that by 12, it comes up to about $204 a month. And what I'm going to do is I'm going to stop sharing this screen and I'm going to share with you another screen that I want you to see where, just give me a quick second. It's a financial calculator. Just give me a second, guys. I got to bring it up. Okay, here we go. All right, just give me a second. All right, here we go. All right, so if you invest the same $204, okay, monthly, $204 every month at 10%, I'm not doing those 12, 13, 14% for 30 years, you're gonna have $469 available there. That is your money, okay? And that money can be invested into mutual funds that you can touch at any time without borrowing the money. That money is already taxed, so you're not going to be paying taxes on that, just the capital gains. Whatever you gain, you will pay taxes on that. But again, you don't have interest rate attached to it. You can sell this. Let's say you're having a wedding, your kid's wedding, your wedding, whatever it is, you can use this money. And I'll give you a quick example. In 1994, when I started to invest first, I was working 2 times a week. I was working as a teller and I was going to school at the same time. I was making $153 every 2 weeks. Okay. So out of that $153, that's when I was introduced to mutual funds. $100 I would put away. So I would put away $200 a month. Okay. And then when I had a birthday, I would add a little bit, whatever birthday money I was given, I was putting away into that fund. 6 years later, I took $12,000 out of that fund to pay a down payment for my apartment. And I paid for my own wedding. At that time, prices were way less than it is right now. But just 200 in 6 years, and and again, market was great, and I got such a return where I was able to afford all that on my own. I did not depend on my parents to pay for my wedding. I took care of it, everything myself from that money that I invested just 6 years. So in 30 years, again, do you need a $500,000 policy if you have 469? No. So after 30 years, even if when the policy expires, well, first of all, depending on your age, you can still get it a different policy, maybe for a lesser amount because your responsibilities will be less at that point. Like, for example, I'll give you a case. If you get married and you have a kid, your kid needs your support. But when the kid is 30 years of age, which is if you have a 30-year policy, the support that you need to provide for your child probably will be gone because your kid will be working at that time, right? So think about it this way. The responsibilities will be less 30 years from now than what you have right now. So a 30-year term, by term, invest the difference. I can't stress it enough. Just be careful what's being sold out there. All right. A lot of times agents will sell you a whole life policy just because the commission is great. Just think about it. Commission on 3,000 versus 500, how much of a difference it is. Okay. Now, this is our information. Okay. Take down this. If you guys need any help, any questions, and we're going to look at the chat to see if there are any questions that we can answer now. But again,
Peter, I just want to add a little bit. It's very important for people to start planning for retirement now. Not when you get close to retirement. You have to have a plan now. At what age you want to retire? How much money you need for retirement, right? Do you have an IRA? Do you have a Roth IRA, SEP IRA, traditional IRA? If you have any questions about any of these retirement plans, feel free to ask us. We can help you with it. But it's important to have a plan, right? If you don't have a plan, you're gonna set yourself up for trouble. Okay.
Now, also just want to mention, so this is our numbers, right? So if you want, if you have any questions, you can contact us. If you want us to mentor you, more than welcome. If you are 18 plus and you guys actually want to get licensed, and if you guys want to learn even more and earn money while you learn, let us know. Our company can sponsor you. And I'm not going to lie to you, it's not an easy test, but you know what? If you can finish college, I'm pretty sure you'll be okay to get your licenses. And as far as the licenses, we can sponsor you for Series 6, 63, 26, life license, and all that. So if you guys are interested, please let us know. And hopefully you were able to learn something. Do we have any questions in the chat, Manny?
I answered, like we had a couple.
Okay, so what we're gonna do, guys, if you want, again, this was recorded. I'm gonna stop recording right now. If you want to stay back and ask a couple of questions, more than welcome. Otherwise, I hope everything was recorded. We'll know soon enough. Okay, guys, but more than